Okay, well, those are some calls that we have for last hour. The market now is really surging, and it looks like 11,650 could be the order of the day. The only missing piece in this equation has been Reliance. That's a stock which is even today underperformed. So I don't know if in the last hour perhaps that can pick up, but other than that, everything else has gone in the bull's favor. But the stock that we're focusing on right now is HDFC Limited. That really is our stock to focus on as far as the stock 360 goes. And you've heard the reason why the stock is up through the day, but let me just extend that point and in terms of where the stock trades. It's up 10% this month. This year it's down 21%, in line with the financials, of course, and from the 52-week lows is down about 24%. And if you see today, it's traded more than 2 times its average volumes, and delivery volumes have already crossed 1,000 crores. In fact, last time I checked, it was close to 1,200 crores of delivery volumes in HDFC. So that's a big number that we are looking at. Now, I was reading a CLSA report this morning, and they're making a very interesting point. I mean, if you see its valuation, Surabhi, the key subsidiaries, before today's rally, 1342, the fair value is 1608. I mean, if you give a 20% discount for holding company, then 1073 and 1286. The mortgage business, the standalone entity, 709 per share and 814 per share. CLSA believes the fair value is 2100 rupees per share, whereas the stock was available at 1782. That was, of course, before today's rally. It's already gone up to 1900 now. Mehrbun Irani is joining us. Mehrbun, good afternoon. Your thoughts on HDFC, which has really been stock of the day? Mehrbun, HDFC?
Yeah. I think, Anuj, the worst for the stock is certainly behind us, as coming back to what the management has mentioned about how the month has gone. Now, the point is the stock has been a great underperformer for the last many months, and with the worst behind it, I think the only way the stock can go ultimately is go up. Now, whether after the sharp up move which we have seen in the recent past, I'm saying in the recent past, and the move which has happened today, can one buy in a hurry for a short-term trade? I won't stick my neck out for that. But certainly from an investment angle, especially considering the fact that it's been a part of the core holding of most retail investors and HNI investors, I think they would do well to continue holding on to the stock despite the run-up which we have seen today, because the point is very clear. Quite a few amongst us believe that the worst for the economy is over. We are looking at 2021-22 with a lot of optimism. And when you look at a stock like HDFC with a management like HDFC, a core stock, which has possibly come off very sharply in the last few months post-COVID. I think this is the stock which, despite the movement which you have seen up nearly 8-9% in the last 10, 15, 20 days, I think there is no reason for investors to be in a hurry to possibly exit the stock. In fact, fresh investment can be considered from the longer term.
Okay, that is on HDFC. Mehrbun, good afternoon. Let me extend the question to banks beyond, of course, the NBFC space, because there's this big catch-up rally that's going on. And while one can understand the excitement around an HDFC bank, the stock I want to ask you about is actually IndusInd, because it's put on 17-18% and it's really playing the catch-up game.
I was hoping that you would possibly mention the name IndusInd Bank, because this is the bank which I have been tracking for quite some years, and despite the mishaps which have happened in the last 18 months, I think the stock, quite a few people said, also ranked type of stock, which was sad for a bank of IndusInd Bank status. I think the promoters putting in money, and quite a few of these accounts which possibly left a little bit of a bitter taste in the hearts and minds and mouths of investors. I think the point is the worst for the bank, according to me, is over. Now, do you look at this bank and say, no, I want to be in it and buy at the present level? I would say, why not? If you're looking at things from a longer term angle, I will still put IndusInd Bank below HDFC Bank and Kotak Bank in that possibly ranking. If you look at a price of 250 with the stock at touched, I don't think anybody would believe the stock touched 250, but it went to 250 rupees. So from 250, you can say the stock has gone all the way up over here. Should I buy right now? But I personally believe if all goes well, if the economy comes back on rails over the next 12 to 18 months, I will not be surprised if the stock is possibly above 900 rupees over the next 12 to 18 months. So despite the fact the stock has run up a little bit too sharply in the recent past, 450 becoming 600 as a sharp up move, I don't think investors who had bought into it were completely terrified when the price came to 250 rupees should now worry. I think the worst is definitely behind the bank and behind the stock. And even at the present level, I think there is room for upside appreciation for the stakeholders. So I would say a 30, 40, 50% up more in the next 12 to 18 months. I will honestly not be surprised. And I have advised my clients possibly to hold on to it, even at the present level. As far as trading goes, where traders can do what they want. After the sharp run-up, it's distinctly possible that the stock may come up a little bit.
Okay, let's move on then and address one more set of stocks. TCS, by the way, that's back in the green, and what a short or shallow correction that was in the morning. But now the TCS will be considering a buyback. Will other IT companies follow suit and announce buyback? Morgan Stanley has come out with an interesting note. Rima has studied that. Rima, what's the key takeaway?
Thanks so much for that. Let me start with what Morgan Stanley has to say on TCS. They say that the maximum buyback size for TCS will be $3 billion. That amounts roughly to 70% of the company's free cash flow. But considering TCS's cash allocation policy is to return 80 to 100% of their free cash flow, there is a possibility that apart from the buyback, the regular dividends from TCS will continue over the course of the year. They also go on to say that while all the large cap IT companies are eligible for a buyback, when they say eligible, they mean that they have completed the 12-month cooling off period which is needed between two successive buybacks. So for instance, for Wipro, the last buyback was completed in September of 2019. For Infosys, it was completed in August 2019, and even for an HCL Technology, it's eligible for a buyback. But amongst them, they expect Infi and Wipro, they believe are likely to announce a buyback roughly of size $2 billion. HCL Technology is also eligible, but considering the company has an active acquisition policy, the odds are not necessarily as high as that of Infosys and Wipro. So in a nutshell, TCS buyback could be close to $3 billion. They could continue with their regular buybacks, and Wipro and Infosys, according to Morgan Stanley, may also look to announce a buyback. Back to you.
Okay, Rima, thanks a lot for that. Mehrbun, IT stocks, which one would be your pick?
I think after the sharp run-up, honestly, one needs a little bit of guts to possibly recommend the stocks, recommend the sector right now. The story is absolutely intact, and I see numbers to be positive, numbers to be good, especially on the margin front. There is going to be a deal ramp up, seasonality, those are the positives as far as the revenues go. But as far as the margin goes, there's a saving in transportation costs, no major wage inflation. So all this augur well for the IT company. The point is, do I buy right now in a hurry? That's a question which is very difficult to answer, absolutely from the short-term angle, because the consensus right now, virtually everybody on the street is saying buy IT, buy IT. But we need to accept the fact that they've gone up a little bit too sharply. So from the longer term angle, I feel the story is absolutely intact. Now, coming back to my pecking order, I would put SCL Tech at number 1, TCS at number 2, Infosys at number 3, and Tech Mahindra at number 4 among the large caps. As far as the mid caps goes, I would put L&T Infotech at number 1, Coforge at number 2, and Mindtree at number 3, followed by Mphasis. So, well, if the stocks are held by investors, they should certainly hold on, because whatever has happened, the digital transformation, which people were expecting would take 8 to 10 years, possibly could now happen in the next 5 years. So all this augurs definitely well for the digital sector, for the digital transformation part, that is the IT industry is going to be a big beneficiary, but the market is accepting it. The market possibly is discounting it right now, at least right now. So the long-term story is intact. Traders can take a call whether they want to add on to their positions right now, but there are those preferred picks, and people, if they are holding on and if they are worried that some correction may come, but if they're investors, I think they may continue to hold on.
All right. Okay, so that's a take on IT coming in. We do need to take a quick break on that note. We'll come back on the other side. And of course, we are today going to be discussing charts and technicals with Sushil Kedia. So back with that conversation in a moment.